why homeownership makes sense. And I think it really ultimately comes down to that for most people. It's like you get to a place in your life, there's so many other factors that are the immeasurables, the intangibles, the feeling of like joy and happiness that a space can give you when it's your own. And those are the things that make people make these decisions. Welcome everybody, episode 36. It's money time. We're talking about real estate today. We're taking a little departure from the normal markets and crypto talk. We're going to be talking about whether it is better to buy or rent your primary residence. This is a topic that we've all discussed at some point or another. And Nick's going to kick us off. It's going to be a fascinating discussion. We're going to get into all kinds of shit. But first, Alfalfa Round, since this is our money segment. Nick, kick us off.
Okay, yeah, I'm next to you, so let's do it. I didn't make too many moves. I did buy a small amount of Facebook puts to hedge my portfolio. So picked one of the highest beta things that could be out there for this week of economic data, and played with it. We'll see how it turns out. And then
those are worthless.
I don't know. They're down and after hours, so we'll see.
Okay,
we'll see. And then also, we were just talking before we press record. I usually have like a certain amount of money that I keep, in living expenses in cash, and I doubled it just because. I don't know. Feels nicer when you just feel like you're going into a time of economic uncertainty. I just kind of
your security bag.
Yeah, like my
your rainy day.
The short-term bag.
Double the length.
Double the length of it to just give more breathing room.
Double the lifestyle.
No, trying to keep that flat. Trying to avoid the hedonic adaptation. Yes.
Very nice.
So those are the two moves.
Nice. I switched it up. I was an option buyer most recently, straddling it, buying puts and calls. The puts are going to expire worthless. I'm talking about ETH options, and ETH is just on a rocket ship right now. We're all loving that. The calls are working clearly. Puts are going to be worthless. But yeah, I sold Leap ETH calls at like the 6K strike. If we hit that.
Wait, what date?
Oh, that's for December 31. That's for June of next year.
June of next year.
Sure.
Leaps, baby.
Playing with fire. I like it.
Yeah, but like if we hit that, you know what? I still got a long bag that I'm happy.
Covered call?
Of course.
Okay, nice.
I mean, I don't think I can even sell calls that aren't covered in the platform that I use, FTX derivatives. So yeah, that's how I went. I even closed some of my shitcoin and shit stonk shorts in advance of FOMC, FOMC. So that worked out pretty well, and I'm comfortable right now.
That's lovely.
Comfortable.
I had a good week at the trading desk. I closed my short hedges in around like 1,400, which was like a small chunk of my stack, and then I made a big scalp trade. Like 1488 ETH.
You're on a nice little run, my friend.
Oh yeah.
Can I size you up?
It was beautiful.
Yeah,
Druckenmiller size you up.
Almost bottom ticked for that move yesterday to $2, and I'm fully long going into FOMC, and then we mega pump. So I'm feeling pretty good about myself.
Are you going to risk off after that pump?
Probably a sign I should, now that I'm bragging about
it. Bragging is always
never a good sign.
Top signal.
This week, like a couple of days ago, I had a call with Josh from TracerDAO.
Shout out Josh.
Thank you for the hookup, Nick.
You're welcome.
And he was like, "Have you heard about this Umami Finance on Arbitrum?" And I was like, "Actually, yes, I have. I talked about it a few weeks ago as like a sort of a symbol of what I hope DeFi can become, which is to create sustainable yields that have some sort of actual value attached to them, where you earn yield not in an inflationary Ponzi token and it's all just nonsense. So they launched a vault today that like I've had my eye on for a while. It uses both TracerDAO and GMX, the increasingly popular perp protocol. I don't know if you'd call it a perp protocol, but the leverage trading on-chain protocol on Arbitrum. And it basically executes like a delta neutral strategy for you using GMX and using TracerDAO to hedge. The yield is about 20% right now. The vault is still closed. I'm probably going to put a a little bit in it for the culture. You know, I haven't farmed in a while because it's been nasty out there and everything's basically been a scam. But I'm hopeful for this project. I haven't bought yet. Been thinking about buying some bags. You know, when I was a little sure we weren't gonna lose another 60% on ETH because all the alts will just go to zero, and I don't feel like dealing with that.
Are you sure now?
No, no. I still only own ETH and cash, and I'll probably just stay that way. You know, my plan is basically like, if we dump, I buy more ETH. If we dump, I buy more ETH. If we keep dumping, I switch my ETH to.
He also owns real estate, just to be clear, just to preface our
We'll get
future
Yeah,
conversation.
we'll get there.
Wait, did you get into the Umami vault? Because it capped at $1 million pretty quickly.
No,
Okay.
no, I did not.
Okay.
I just like it. I like the
Agreed.
idea of it. It gives me hope for DeFi.
They called it real yield, and I feel like that was a fairly
And it's real
safe
because it pays USDC. Is that why it's real?
It pays USDC in ETH, I believe.
The yield comes from trading fees on.
Actual trading fees from the platform.
Yeah,
right from the
like when traders leverage trade, they lose, right? You're sort of playing the casino, right? So you can see, the yield comes from degen apes levered trading and losing, and from the fees they pay, right? So you're providing liquidity, you're getting fees, and also you're kind of playing the casino where you're taking the other side of it and you're getting an implied expected value for taking on that risk, right? So the yield comes from a place where you're like, oh, this is a real thing. You've got smart contract risk, obviously always a annoying thing in DeFi, but at least you can kind of see what's happening here. There's some sort of real value being provided. We're abstracting away a difficult to execute strategy that no user would really be able to do on their own if they couldn't like write a bot to kind of do this like hedging in real time. And this is kind of where I see everything going. I think eventually we all get an app, we pull it up, we're like, hey, what do you want to do with your ETH? You click a button and it executes some automated strategy for you. And then you go back to work and you sleep cozy knowing that your money's safe and you're yielding.
Sign me up.
That's
for
the future
this.
of real tokenomics.
Yeah.
The future. Doesn't exist today though.
Would a young Taylor from Billions, that quant, be proud? I feel like this is something that like would normally take some kind of advanced trader at a hedge fund to implement, and now you can do it in DeFi pretty simply.
Be proud and unemployed.
Yeah, that's right. All right, cool.
Cool. Good shit. For me, I started dabbling my way back into NFT land over this last week a little bit. I have a sort of shopping list of items that I've been that I'd written down that I generally wanted to own going into the next bull market. One of those projects I was telling you, Eric, the other day that I'm generally long-term bullish on is 10KTF, which is the Beeple project, among other people involved. And I scooped up this Moonbird bag item that I'm very excited about. That I think somebody mistakenly
like a literal bag.
No, it's like a backpack for the metaverse.
Oh, so it is a bag. It is a bag.
Yes, a literal bag.
Okay.
Yeah, literal
Just
bag.
wanted to clarify.
And it's like a little day bag, Moonbird item. And I got it cheap. I think the person that listed it didn't really realize the value. So that, among other things, and really ultimately, like, I think everyone is still just trying to figure out what this market is going to look like and the relationship between like fiat and ETH, and if we really have like already bottomed ETH, what that looks like for the future of NFTs. What I do know is that if you look back historically, the last time that certain people used their ETH to get to mint as many projects as possible, which is another part of my strategy going into the next bull run, is like when things really get quiet and projects start minting, I'm going to be minting as many projects as possible. One of those might end up being a Bored Ape. And I think that ultimately, like, what we learned from the last cycle is like the biggest winners were those people that just minted the right projects. And so I want to buy ETH as cheap as possible right now. And I want to take a certain amount of that allocation and put it toward NFTs, but not more than necessary according to like my personal allocation and thesis. So that's where I'm at. Scooped up a few NFTs and
Awesome.
Yeah.
Sounds fun.
Yeah, I needed a little bit of like intoxication.
A little dopamine hit.
Yeah, a little something. So we're talking real estate. I want to
Yeah.
get right to the fucking meat. So
Let's do it.
Take us there.
Yeah, so I think this is a really fun topic. I also think it's not only a fun topic to go about because people often have differing views about this, but it also for human being is one of the biggest financial decisions you'll make. So it's a decision of great consequence. I was looking at some data a few months ago, and I pulled up the stat. It looked at home ownership over generations. So it looked at when baby boomers were 30 years old, their home ownership percentage was 51%. And you go to the next generation,
Wow.
Gen Xers, when they were 30, it dipped down to 48%. And millennials, when a millennial's 30 on average, they have 42% home ownership. So it's obviously declining.
It's declining. What? Just out of curiosity, what do they define those
Age ranges?
segments as?
I didn't pull that up, but I think it's probably your standard.
20, 30 years kind of thing?
Before we go on from that point, that's really fascinating. What percentage of people would you say 30 years old, San Diego, any major city right now own?
Oh, well, if you're talking big cities, I
Much
mean,
lower.
nothing.
Much
this is why it's
So that's why I find that data fascinating.
is it because it's not
This is
affordable
not
anymore?
people living in major cities.
We lived in San Francisco for almost a decade, and nobody,
Nobody.
and everybody was like doing well in life. Nobody owned a home.
Everyone made six figures. No one owned a residence.
And everyone, not only that, they all rented, and they also all had roommates.
And they lived in 100-year-old like
Almost.
homes and apartment complexes.
You said 42%.
Yeah.
Right now, right?
Well, yeah,
so high.
not right now, but like when if you look at
Millennials. in
millennials
general,
at the age of
at
30.
the age of 30.
Right.
Yeah, that doesn't check out at all,
all.
for SoCal.
No.
Any
Not
big
even-
city.
If I had to
Especially
guess,
if we go back in time to when we were 30, like how many people do we know were 30 and owned?
15%
It was
would be my
super
guess.
low. Yeah.
Yeah.
15.
And I think like the median home price right now is somewhere around 400K ish. Don't quote me on that, but like that's laughable in San Diego. Like you can't even
That's
find
my
like a shelter.
bathroom.
Yeah, exactly.
Yeah.
Okay.
So I think big cities are definitely
Cool.
the
Well, that's very interesting.
exclusion
But
to the
it
rule.
helps me understand that actually millennials on average, like in the rest of the country, are that's what they're
Over
doing.
40% of them. That's
Yeah.
crazy.
So then
cool.
the next question comes is, well, is it because of affordability? It just for each generation, it's becoming less and less affordable to buy a house, or is it a proactive decision to say it doesn't make sense to buy a home? It makes sense to rent. And so to set this up, this is a good conversation between the four of us because we have two homeowners and two people have chosen to rent, at least for now. So I think it gives a good fodder for the discussion. And where I always get troubled when I read articles or see YouTube clips or Instagram clips is that the conversation is never comprehensive. It's never collectively exhaustive in terms of what goes in and out financially in both scenarios. And so what I have here is a calculator that I originally borrowed from Saul Kahn from Khan Academy. I think he published this thing like over 10 years ago, and it's still one of the best calculators. It's an Excel calculator. So if anyone wants it in the Discord, just drop a note and we'll plop it in there. But it does a better job of helping us answer this question. So for example, for owning, it obviously takes into purchase price, the down payment. It takes in the proper interest amortization because typically you're paying more interest than principal in your loan. Annual maintenance, HOA fees, insurance, property taxes, appreciation, the tax savings on those property taxes and interest based on your marginal tax rate, inflation, the closing costs when you sell, and then a rent side, it takes into like all-in costs, like what's your renter's insurance, parking fees, all that kind of stuff. And of course, the return on the capital saved from not having to place a down payment. Some things that are not included in this is your choice to remodel, like that's like maybe optional, so that's not included. Time spent on either buying a home or finding a rental, finding a mortgage, handling repairs, things like that. Doesn't take into account like moving expenses for renters because more often than not, you might move more if you're a renter. Also doesn't take into account the flexibility of movement. So that is kind of like the qualitative things that people have to weave into this algo, if you will.
Love the comprehensiveness of your introduction here.
Yeah.
These are all important.
Well, this is what I
factors
think about.
that most people don't consider when making that very
Right.
binary.
And there's qualitative factors as well.
Totally. Lifestyle factors.
Yeah. So like a spreadsheet can't even encapsulate that stuff.
Right.
time.
But this does the best way because what it does is says what's the average length of holding a home? It's roughly 10 years. So it says, okay, let's play out both scenarios, renting and buying the same exact home or apples to apples. And what happens after 10 years, after you sell that home, and it takes the net present value
I like that. So
back from 10 years.
this is great. I can't wait to dig into to some scenarios on the spreadsheet that we.
Is there a tinfoil take to this? Possibly.
Yeah, give it time.
Okay.
Give it a second.
let
So
the
let him warm up.
let the agave
I'm
juice
curious.
kick in.
I got a
curious where
tinfoil
Nick's,
take later on.
I'm curious where Nick's numbers came out because I ran some numbers as well.
Okay.
Through different calculator.
Great.
So
Here's where I plugged in some data for a place in our area here. Got the rental rates, got the most recent sales price, and in general, just to put it out there, the conclusion up front, my take is that it's often a better financial, better investment decision to rent over buy. The exclusion would have been the last 2 to 3 years, where you got a levered 30%.
You're
return.
not even considering the qualitative factors. You're just literally looking at a math problem.
Yeah, like what's going to put more money in my pocket, present value.
Yeah.
So this is a $1.8 million 2-bed, 2-bath. I don't think it's even 2,000 square feet. But
Casual.
That's what they are in San Diego.
probably across the street from me.
Yep. Looks at
90 years old.
a typical 20% down payment. Right now, interest rates are 6%. It puts a property tax rate. It was at 1.1% here in San Diego, something like that. Annual maintenance and HOA fees round up to about 1%. And then there's some other, inputs, but the other big inputs are the rent, which is $5,700 a month. And then the big one is, what is your assumed annual after-tax return on your cash?
Sorry, what was the rent on that?
$5,700.
Okay.
Yeah.
That's fair.
That's-
I thought we dropped a zero. On
What you said in the last thing, like all these other things when I did this were sort of like small potatoes, like your maintenance, all like your tax rate matters a little bit. But the big thing was like, what is your opportunity cost on the money
No doubt.
that you would otherwise put into your
That's what
down
swings
payment?
this
Everybody
thing
wants to
from
know.
red to green in either direction.
Absolutely.
Yeah. So, I have my after-tax return from investing in apartment complexes, which is what I've decided to do instead of, put a down payment on a home. But you could say I want in the S&P 500 and lower it to 6%. You could say I'm going to degen into ETH and give yourself a 25% annual return. I don't know, over 10 years, something like that. But in any case, in most cases,
MZY would tell you it's 2,500%.
We got some
6 months.
yeah, the Uber bulls in the Discord would probably like to jack that number up. But even when I have like an average interest rate and even like a 6% annual return, it's still the net present value is in the positive for renting.
For renting.
For renting.
God, I can't. I got completely opposite numbers.
Well, so
I'm curious what happened.
now if this is a 6% mortgage rate, which is what's happening now.
Oh, that's.
But like obviously, if you got your mortgage even a year ago,
is
you're at
6% the
2.
rate now? Like I. Heard
Oh
you
yeah,
could
brother.
Still get
We just went
6%.
we went 3 standard deviations in the positive from where we were.
But I think
Be right
what we're
back,
talking
people.
about is like how much timing affects every investment.
Right.
Like, it really does.
And there was a take that like, I'll just sell my house when the market's up. But I think there's a timing aspect. Like when you own a home, there's so many other factors that come to sell. You can't just sell it like ETH or a
Yeah,
stock
they're not as liquid as
you'd like.
market assets.
Yeah, so it's difficult to capture those returns at the top if that's your plan.
Right.
Yeah.
So outside of this last 3-year period, would most scenarios fall under that math?
Yeah. And I'm talking like obviously with the house price like 1.8 million, the numbers are bigger, but you're talking like anywhere from high 5 figures
Yep.
to
All
into
those
6
levers
figures.
are different, particularly the interest rate, but also the cost of the house.
What did you
itself.
have as your opportunity cost for return in like?
Well, my
stocks?
personal one,
Yeah.
it was 15% after taxes.
Woo, what a genius.
Well, I mean that's what I'm
was
getting.
good.
I'm getting more than that
Long-term
on
capital
the
gains.
multifamily.
15 is epic. All
Well,
right,
I'm not paying taxes on any of the returns either.
0%.
1031ing.
But like another component of this, man, it's so hard because like you can't really compare anything sort of like in isolation, apples to apples, really, because everything is like essentially what you're doing is comparing beta. Like, equity beta is going to outperform sort of like real estate returns over a long period of time, and that's like the comparison you're making. I agree with that, but
Wait, did you say equity outperforms Real estate?
Yeah, equity like stocks outperform real estate.
Yeah, I
You're
did-
talking
I-
single family homes specifically,
Yeah,
right?
yeah. I think-
I did research on this and I found the opposite.
What'd you
like in
find?
the numbers I pulled.
No
it was
way.
pretty close though.
I thought
No.
single family homes are like a 3%.
No, the real
average.
return is actually
No,
way
they're
lower.
3%, but you're not factoring in the leverage you get from a mortgage, which is like
Absolutely.
the big thing.
Absolutely.
Like this is
Okay.
why this is such a complicated
I don't-
problem.
Yeah, but when you
Because-
sell it, you have to pay back the debt.
No, but you like
No,
if
but
you take
you're leveraged.
if you
get a
take
mortgage.
5x leverage up front because you're only paying 20% down, like this bet becomes like really magnified. Like your returns get really magnified, and this is like normalized. Like people in real estate don't blink. Like they actually think that 20% down is actually like you're really collateralized, and it's like
Yeah, it's kind of funny.
If you do that in stocks, it's like you're getting liquidated immediately.
Yeah. Like if I rolled up in the Discord today and I was like, I went 5x long for 40% of my net worth, which is what people do very frequently in real estate, if not more, you guys would be like,
Yeah, but there's good collateral, right? And the bank owns the note, so it's like we'll just take.
it's
your
normal.
keys.
It's
Yeah.
normal in real estate.
Yeah.
But yeah, Eric, you're right. I mean, like when I pulled the sort of non-leveraged, it was 3.9%.
Okay.
For the last 26 years. If you take it, and again, this is everything. It's so market dependent, but it's only 3.9%. But I think an interesting
Is that
comparison.
nominal or real? Because I think
Nominal.
The real is like it's
The real
like
is
1% or
yeah,
less.
exactly. That's just nominal.
Yeah.
I think an interesting thing to do is to take REITs, with real estate investment trusts, like from stock market, right? You can pull REIT returns, and you actually get like
I fucking
you get about
hate REITs.
10%, and I think you get in the 9s for like other stocks. So it's very close, like residential REITs versus stocks, and those REITs they're leveraging, they are taking on debt, they're doing similar stuff to what you would do. So I think it's kind of like it's very comparable. What's interesting is like I ran the numbers that you ran, but I ran them with like kind of like the old rates, where it was like a 3.7% mortgage. And with those rates, I had to get a 19% return on my
Right.
capital to make it sense to not own, to rent instead.
Like I remember when when rates were near zero, Warren Buffett, the stock guru, said there's no better investment than a single family home right now. And that this guy invests only in stocks.
Agreed. That makes sense. When
Yeah.
when the cost of money is so cheap, you're going to see a price inflection in the home prices for sure, which we saw.
So it's
And-
entirely market dependent. That's the problem. Like
Right.
with this conversation.
But you can see why real estate goes haywire, right? Like if a couple of people run some basic math and go like, oh, this is like an 18, 19, 20% return, I'll just bid real estate. And obviously real estate goes to the moon until it gets to the point where the returns kind of equalize against
But
stocks.
also, like,
to a
let's
degree.
talk about the risk side too. Like a home doesn't go down in value as much as like the Nasdaq has, or maybe not like as much as ARK has, for instance.
Yeah, I mean, tell people who bought in 2007, 2008, that didn't
But-
probably feel good.
Yeah, it didn't feel good, but like it's a less volatile asset class. So like even if it has lower returns, it also has lower risk. Like if you're talking about Sharpe ratio, it's a different conversation.
I think the risk more lies in the type of debt that you take. In this, I think in our assumptions, like we're not looking at anything exotic, but it depends on the type of debt. If it's variable debt, you're way risky. You're way, you can get caught with your pants down. And depending on how many mortgages you have, I mean, that was the cause of, the Big Short.
So is there a very clear, definite answer on this first aspect of the quantitative piece?
Yeah,
Like-
to me, it's like unequivocal in most average scenarios that renting,
Most scenarios over time,
you're going to end up
as
with
far
more
as,
money
like-
in your pocket on a net present value basis.
even considering
well, he's talking about a specific.
We're also using two different
generalize
calculators.
a little bit more on it, because
Yeah.
it's obviously nuanced and it's complicated and there's a lot of variables. So we're gonna gloss over some stuff. But I mean, I remember doing this math when did I move to San Diego? I was like 25, 26, and I did the math on this, and I was playing poker at the time, and I was doing like these like all these like random investment. I was doing a lot of stuff like you did. I was a lot more active. And I ran the math on it, and I was like, why am I going to buy a house? It made no sense to me at the time when I crunched the numbers. I think this is especially true if you're younger, if you are starting businesses, if you are doing more aggressive stuff with your capital. Like if you're like a single 24-year-old guy who's made some cash and you want to like put in a bunch of work and like aggressively grow that capital, like real estate isn't really the thing.
Single family home
Single
real estate. We
family,
should always
yeah.
clarify. Yeah.
Yeah, but like once you start talking about like hustling and doing stuff, and then you're like, oh, I'm hustling and hunting down apartment deals and running these deals. It's
There's so
different.
many people though that argue, especially real estate gurus and influencers, that argue for the power of like your primary investment at a young age should be real estate before stocks because of the power of the fact that you're 5x like leveraged on something that like not and look at it in 30 years, like you have passive cash flow from that in 30 years from now, if you could even pay it off sooner.
Yeah,
So,
I think the classic overgeneralization is like, well, don't pay off your landlord's mortgage. Pay
Yeah.
off your own. Build equity in your own house, and that's just an oversimplification.
You're throwing money away,
Right.
Like
it's just
everybody always says you're throwing.
But
money
I
away.
want to hit some of these, like, if we're going to call them myths and debunk them a little bit. Like, that is the classic saying. That is
Right.
what I hear commonly every single day. It's like, I would rather not put my money in my landlord's pocket. I'd rather like build up something of value as an asset that even I own maybe 30% of, but to me it's still more worthwhile. And the leverage is like important because you can do so much with that.
Sure. And
Sure.
is your biggest consternation that like the amortization schedule means that you're paying like 99.6% interest right from the beginning, and then it scales down from there, but it's all interest at the beginning?
Yeah, I think that's one of them. It's also that maybe I'll put that as number one. Number two is like underestimating maintenance costs. Two, property
Everybody
taxes,
does
and then three, just the opportunity cost is the biggest one.
I don't think you mentioned insurance too. That's another expense.
Yeah,
that's like on there.
for sure, that's in there. And this is taken into account.
Fucking HOA forever on some like condos and apartments.
Oh my god, it's
like
insane in San
forever.
Diego. Yeah.
Right. And like
And that only goes up.
HOAs are so ridiculous. I don't know what, because people own in your building, and like
Right.
HOA is probably $1,000 a month.
Exactly $1,000 a month.
Ugh.
And so your annual maintenance cost as a percentage of your home value is lower, but still it's that doesn't go anywhere.
Yeah,
that doesn't go
Ever.
to pay the loan. Yeah.
Ever.
Maintenance is the nasty one
Right.
that like sneaks up on people, right? But the other thing that people don't think about, and it's not necessarily a bad thing, but when you buy a place and then you want to make your own, and you buy a house, then suddenly you want to buy a little nicer furniture because you're going to be there more than a year, and then you want to buy some art, and then the next thing you know, you've turned around and dumped like a huge chunk of the purchase price into just furnishing.
Are you
and
speaking
decorating.
for a friend?
Oh, you
or
might,
personally?
you might have a fiance that only wants RH time. You might.
So that's where I think things get really interesting, is the discussion around the qualitative aspects of why homeownership makes sense. And I think it really ultimately comes down to that for most people. It's like you get to a place in your life, there's so many other factors that are the immeasurables, the intangibles, the feeling of like joy and happiness that a space can give you when it's your own. And those are the things that make people make these decisions that maybe don't make sense in terms of like opportunity costs and the math on the investment as a whole in comparison to say Ethereum, which we can get into.
Yep.
But qualitatively, there's so many reasons that are just unpredictable and variable from person to person that for me, I personally like never had. I never had that inclination, that desire to want to own a property. I
Own a
felt-
headache? You like being a property manager?
That's what it is to me, because I'm like the opposite of my dad. My dad does everything himself with his hands. He built his current home. Like he built his
You're right.
dream home. He architected it. He constructed it. He basically was like general contractor. He created a vineyard. If there's a problem, he gets to the root of it. He YouTubes it. Now he's like, now I have fucking YouTube, son. Like I can figure out anything. And so I don't have that desire whatsoever. So I've always known that like my maintenance cost is going to be like triple most people's, because I already outsource everything. So it's a huge headache for me. But I'm getting to a point where I'm like, that would be nice.
Yeah.
It could be good. There's a future here where I can be comfortable.
Yeah, you
and-
outsource your IKEA building.
You do.
I do. Is that bad?
No,
Should I
I
be
mean,
embarrassed?
it's, to each their
I'm not.
own. I think there's also like a overemphasis on homeownership when it comes to like the health of the general economy. You often hear like homeownership is going up or down, and like I don't think that's like a good metric for the overall economy. Like I think it was Bush and Greenspan were like, well, we want everyone to be able to afford a home. We want people to have the American dream to be able to purchase a home. Interest rates were low, and we eased lending standards, and it turns out that not everyone can afford a home. And so I don't know if home ownership is like a good example for the economy, or a good metric of the economy. But my question comes, let's say you believe this model that like most of the time it makes sense to rent. You're going to have more money in your pocket on a net present value basis than if you owned a home. But when do you buy one?
No, I think this is just saying that it's mathematically in
Correct.
your favor to own higher volatility, higher return assets, like higher risk, higher return assets pay more over time. Like that's the conversation we're having, and I don't think it's really apples to apples.
But what else would you put your money in?
Like Steven said, like REITs versus stocks is actually like a better comparison.
Well, it's fine. If I put 6% in this calculator, it's still in the positive. Yep.
What if you put 11%
It's even better.
stocks?
Oh, yeah, even better. If your opportunity cost is...
Oh, sure.
Yeah, that's what I'm saying. The higher it is better, but like
Yeah,
it
no,
doesn't
but
have to be that
think
high.
These rates are not going to sustain though. Like 6% mortgage is going to come down.
Agreed.
A lot, right? And I saw in my calculations that what we had before, like 3.6, it was like buy. What
It's
are you
a
doing?
no-brainer
Buy
at
a
that
house.
point.
Yeah.
And we had like in the 2s, right? So I think if you're going to get like a 4% mortgage, especially if you want to, we're looking at like this historical data, right? But let's put on our extrapolation caps for a moment, because we all make investments thinking the future is going to be a particular way, and we all, I think we're going to be entering this sort of paradigm where we're going to start monetizing a lot of debt. I think that your numbers moving forward, we should probably skew them. I think it's probably, this goes in the face of a lot of things people tell you, but I think it's probably a good time to take on a lot of debt coming up, right? Because
Because you can refi later or what?
I think we're just going to enter a decade or 2-decade period, right, where governments have to choose between defaulting on debt, austerity, and a deflationary economic collapse, or they have to monetize the debt.
Print
We are
money.
not in a-
So there is
they
no
have to print
choice.
money.
Print money.
So if you believe that's the case, you should, even right now, right, we're like, oh my God, inflation's going crazy, but real rates, right? If you take like GDP and like real rates are negative right now
Yeah,
by a
let's-
lot.
And let's remove one of those from the equation because they're not going to choose austerity. So they're going to print money.
They're obviously
Choiceless
not, right?
choice.
They're going
Yeah.
to print money, right? So not financial advice, but like you should probably be taking on debt if you think you're entering an environment where your debt is going to be monetized away. You generally want to.
What kind of debt are you talking about here, to be specific?
So when you take out a mortgage, right, your mortgage is benchmarked to like treasury rates, right? So if you think the U.S. is going to print a bunch of money, the going thought, right, is that like we cannot get out of this purely by growing. We have to grow GDP at some absurd amount. But given the fact that the demographics in the Western world look so shit right now, we're not going to be able to grow at that rate unless we like discover cold fusion tomorrow, or there's
Or
some
massive
crazy
immigration.
Yeah, well, we have that card to play here in the U.S., so I think we'll maybe be okay there, right? But like, what we're going to try to do is force people into bonds to kind of keep the rates lower than they should be given inflation, and then we're going to try to turn on the money printers to stimulate growth, and we're going to try to get into this paradigm where we have like 5% inflation, but like 8% GDP or something crazy, and then run that for like a decade. Because then you're basically like borrowing money at 3%, like negative 3%, right? Like if you're the government, you're basically you're monetizing the debt. So in that type of environment, you don't want to be somebody lending money. You want to be somebody borrowing money, because the money that you're paying back in the future isn't just a factor of like your interest rate. It's also a factor of the inflation. You are paying back money in the future that is worth less than what you borrowed it for. So it is just sort of like mathematically.
Yeah.
This isn't to say you should take out mortgages that are far in excess of what you could pay for with adjustable rates. But if you take out like a 30-year mortgage that's well within your means of paying for it, like that feels like it's going to be an obviously good decision, especially if we're like 6 months from now, rates are still kind of high and property prices have collapsed. That could be a really good opportunity, because you could probably get into something when people are like, I'm out selling, you could get ahead of a pivot where rates end up going back the other direction again. Then you can refi.
Oh yeah.
That's
Get
my
a lower
plan.
rate, and then your value is going
literally
to
my
be pushed
plan.
up, and then they're going to inflate away your
So,
mortgage. It's like a triple dip.
I agree. I think I just still think it's better to put that money into, say, income producing real estate where you do get the leverage. And if you do get it in at a higher interest rate, later on when interest rates go down, you can refi and pull out money
So-
tax free.
If you have the time and
Let me
energy
ask.
to
Let me
do it,
ask
yeah.
Nick. Like, what's it going to take for you to personally ever purchase a primary residence? Is it going to be purely qualitative, or is there ever a time where even what Stephen just described, like that's like my play. That's like a
Right.
good opportunity. Is that what something you're thinking about?
Yeah, I don't think of it within the investment thing. I think of it more
Yeah.
like a consumption thing. Like I
Lifestyle.
I buy this laptop. I don't think it was an
And
investment.
you don't
but it's
buy
micro-
shit, so this would be a big purchase.
Right, I'd be freaking out. But I think of it more as a consumption thing rather than an investment. Like I'm going to use this to consume something. But yeah, I think in general it would be nice to do it with when money's cheap. But it is tough. Every time I get close to even thinking about it, I'm like, but my opportunity cost.
So it's literally a purely emotional purchase for you,
Right.
Like there's nothing about it that would ever equate to like being a good investment. decision.
and hopefully
For you.
because of investments made 5 years ago, my hope is that I'll only have to pay for the down payment, and the cash flow from
Right.
the rental real estate will just more
for your
than
mortgage.
pay for the mortgage. So
That's a great sequence of events.
So there's like a
jealous.
like this conversation has been good and nuanced. Like
What do you want?
the spicier take that I've heard, the
it
algo has brought out a spicier take saying that primary residence is not an investment at all, and that's a take that I'd refute wholeheartedly.
Yeah. Why?
Well, because it makes up 30% of American wealth, and those numbers do go up over time, so that can be an investment clearly.
all right, so here's the counter to that, and this is an old school book, Rich Dad Poor Dad take is that
First one I ever read that like put me on this path of
Same.
Big
wealth
Robert.
building.
yeah, Robert Kiyosaki. Anyway, you can laugh at him all you
the
want.
irony is he's like the biggest real estate guy of all time. Like
Yeah,
he's,
he
like,
is.
he's a huge real
Doesn't
estate
he?
guy.
I haven't read his stuff. Doesn't he just like do
I've-
real estate and then pour it all in the gold?
And
He's
Bitcoin now.
big gold and
He's just a
Bitcoin guy.
big
He's a
end of the world
Bitcoiner.
guy.
I've even been co-invest. We're happen to be in some of the same properties together, same apartment complexes by accident. But in any case, he describes an investment or maybe an asset as, does it put cash in your pocket or does it pull cash out of your pocket?
I think it's a great way to look at
And
it.
so
I think it's terrible.
it's terrible because it doesn't necessarily take into appreciation, but it does get to I think for the average American, for maybe an average
Based
investor,
on his outcome, though.
right? He's like, okay, you're going to buy a home and it's going to suck more cash out of your pocket than would rent. And if you bought rental real estate or some other type of investment, it would have put cash in your pocket. And really,
You have
like,
to buy it anyways. I mean, it is a cash outflow either way. Even buying a stock's a cash outflow. Like everything's a cash outflow. Using his framework,
yes,
buying ETH is a cash outflow. Like it's.
but you
not
can reduce
putting-
your net outflow from rent if you invest the down payment in a
I'm
better
just pointing out why it's a silly framework
Right.
that he uses to say like what is an investment, what isn't. I think it's.
But like
ridiculous.
I like that because like just like a business, your business survives on cash. And once you run out of cash and once you're cash flow negative, like you enter into the fucking danger zone. And that also happens to be like when you're living your monthly life. Like once you're negative cash flow and you're burning into your savings, life is very, very stressful. And so I think a good, if it's not technically correct, a good advice is like if something put cash in your pocket, generally put in the asset column, not the liability column. And if someone takes cash out of your pocket, the liability, goes in the liability column. So I think that's the counter to it that.
Yeah, I think it's just like a little. You're going high level, like higher skill level, because like we said that 42% of millennials own homes. We know freaking none of them at age 30. So what I'm seeing is that like a lot of people are making this decision, and it's not like they're not buying cars and flat screen TVs. They're buying a home, and I think it's actually an improvement on consumer debt. Like this
versus
actually,
credit cards.
Yeah,
and,
this actually is an investment. And I'm only refuting a comment that you've made aside of the podcast, not even something you've said today. This is just like this is one of your, you plant your flag. Like a primary residence is not an investment.
Okay, if it is, it's not a good one, is what I'm saying.
Yeah, it's not optimized, perhaps, but I go back to that idea that's like, well, real estate is lower return, lower risk than everything you've talked about.
That was well said. It's the most accessible and sort of like well taught. There is a clear roadmap to follow in
It
society.
could be like a level 1.
It's hard to
thing.
fuck it up.
You don't have to go
Yeah.
to level 10 of investment
Yeah.
knowledge. You can start at level
Also,
1.
like
and 5.
the 99% of humans aren't like the algo over here, right? They're not like, I'm
He
going
likes
to
that.
allocate all of my free capital to like they're just like they think they'll do it, but in reality they take their free cash flow and then they spend it on dumb shit. So
Right.
real estate, although it might be slightly negative EV in theory, like ends up being plus EV for people because it turns them into forced savers where they otherwise
provides constraints.
So
Yes.
good for society.
they may
as a
otherwise
whole.
have taken that money and they may have spent it on like Dogecoin or put it in some dumb startup that their
Well,
buddy.
That's a
like,
phenomenal investment. So
Yeah, Armand's still holding
Hold on.
Doge, I'm pretty sure.
I'm absolutely still holding it.
I should clarify.
Try to come get it.
Yeah,
'cause
they
you're
put
not
it. They
getting
put it in Dogecoin like pre
diamond hands.
pre Elon SL, pre SL.
I remember I told Steven I bought Dogecoin at 4 cents, and then I think it ripped to
Like 50 cents.
26 cents after some event, and I called him like, "Hey, dude, what is this fucking Dogecoin?" I was like, "What do I do with this?" He's like, "You bought Dogecoin, dude?"
Yeah, and then like
I'm like, "Yeah, man,
on,
I was
like-
fucking gambling."
a year later, Steven was like, I just realized the highest possible Sharpe ratio actually includes a little Dogecoin.
Numbers don't lie.
I'm not gonna mess with a meme. Memes are powerful. I'm
Learn
always
that.
gonna.
Definitely
I'm
learn that.
always gonna hold
GameStop,
a little
learn
Dogecoin.
that.
Always.
All right, cool.
Shouldn't have sold that either. Fuck.
Learned that the hard way.
I think I have one more thing to say on this topic before
Yes.
we wrap it up. I have like a sort of mental model that's worked for me about this, right? I think you have to decide what type of person you are first and like how old you are, right? So
You decide how old you are, or
no, you decide what
Okay, just
type of
clarifying how
person
you
you
said
are,
that.
and then you are old.
okay.
You cannot just identify as being not.
Sorry, I've had a full thing.
Sorry.
I'll keep it for the alcohol
Yeah.
episode.
I think in life, like at the extremes, right? You can aspire to be like, this is going to pull something from Fooled by Randomness by the guy who blocked me on Twitter, Taleb. You can be you can aspire to be a dentist in life, or you can aspire to like own a jet, right? To own a dentist is to pick a path that guarantees an incremental linear path to a very comfortable life with no prayer of ever owning a jet, but also no chance virtually of being in poverty. The other path is a path of like taking risks and trying to get into like a higher echelon, right? When I was younger, I viewed wealth from my perspective as like a step function, right? It's not this linear thing where you build to me, right? Like if you have $400 to your name, it's going to do you zero good to invest your $400 at 6% a year. You're never going to be a millionaire.
You're not going
doing
to
that.
make it that way.
You are not going to make it that way, right? So if you're on the dentist path, then yeah, you put your money in the real estate, you incrementally grow, you just keep doing that, you go back to being a dentist, you make your $350K a year at some day, you retire, you're very comfortable, and you go on with your life, right? But if that's not your path, right, then wealth is a step function, right? It's not linear. Like going from doubling your money from $500 to $1,000 doesn't do shit, right? You have to 10x your money, and then you have to 10x your money again. Like you're not going to
Are you
do that.
including like the power of like compound math in that though? Like, because if you just keep,
I am, because if you start with $100, there's no amount of compounding in this
Like,
lifetime that's going to
Yeah,
get
the
you to do anything.
years required just goes beyond.
Sure.
Like
At
you have to
$100,
like when I was younger, like I was like, can I make 30, 40, 50% on my money by being like very active in what I do and being very risky in the bets I take and the stuff that I'm doing, right? If that's your mindset, then you shouldn't be putting money into real estate. You should be keeping as much cash as possible when you're younger and taking those risks. Because if you lose the money, whatever, you just start over again. And it doesn't matter, you're young or single. If that's like what your take on life is, I want to view wealth as the step function. I want to climb the steps. Then real estate's just not a good investment as like a young 20s person who is like trying to actively put his money to work, take risks and do it. Unless You were trying to do that literally in real estate and lever up and start a fund and raise a bunch of investors and stuff. That's totally different. But if you're like an entrepreneur and you've got like a dream and you've got all these things and hustle, you're going to get a way higher return on your capital when you're younger doing that. Like, it's not going to be a great return on your time, but your time isn't worth anything then. And that's what I did when I was younger. I definitely like eschewed real estate. I put the capital to doing the step function stuff and trying to like leapfrog into like a new tier. And as I've gotten older, like I've definitely mentally shifted into, I need to preserve what I have and grow, and I'm going to be on a good path now. So I think it's important for people to ask who they are, how old they are, what these goals are. Are you the dentist or are you the jet wannabe? And that's going to like kind of be, because real estate is not good or bad in isolation. It's good for some people. It's bad for others, depending on their alternatives. And that's all I have to say on that.
Yeah, that's good guidance.
Good one. Yeah, I like it.
Let's end it there with some sweet, sweet philosophy by the personality. So in the next episode, we're going to be talking about radically moderate thinking in a polarized world, and we're going to actually tell you guys what this whole radical moderate thing means. See you guys there. Peace.
Bye.
Bye.